Hey there. So you've just started your first job. You get that first payslip and you see this thing called a CPF deduction. It can be a little confusing, right? Well, today we're going to break down exactly what CPF is and show you why it's actually one of the best financial tools you'll have in Singapore. Let's jump right in. Okay, picture this. You open that first ever payslip, feeling like you're on top of the world, and then you see it. A chunk of your salary seems to have vanished into this CPF thing. Your first thought is probably, hey, where did my money go? Don't worry, we've all been there. But here's the good news. That money is very much still yours, and it's already working hard for your future. So what is CPF? It stands for the Central Provident Fund. The easiest way to think about it is not as a tax, but as a forced savings plan. It's a system designed to make sure we, all of us, can afford the big, important things in life. A home to live in, our healthcare bills, and a comfortable retirement. Now here's where it gets really interesting. You're not the only one putting money into your CPF accounts. Your employer has to contribute too. Let's take a look at how those numbers add up. If you're 55 or younger, you contribute 20% of your monthly salary. But on top of that, your boss adds another 17%. You do the math, that's a total of 37% of your salary going into your savings every single month. It's basically like getting an extra 17% from your company that's dedicated entirely to your future. Just a quick note, these percentages apply up to a certain salary level, which is known as the CPF wage ceiling. This ceiling is going up, and by 2026, it'll be set at $8,000 a month. So if you earn more than that, your contributions are just calculated on the first $8,000. It's just a way to keep the system fair and up to date. And as you can see, these rates do change as you get older. They gradually decrease a bit. This is really to encourage companies to hire and keep experienced older workers on their teams. But for you, starting out in your career, that 37% is the number to focus on. It's designed to be highest when you're young, to give you the longest possible time to grow your money. So where does all this money actually go? It doesn't just get dumped into one giant account. Instead, it gets split into 3 separate accounts. Think of it like a financial toolkit, where each account is a different tool for a different job. First up, you have your ordinary account, or OA. This is probably the account you'll get familiar with first. It's your home and more tool. Its biggest job is to help you pay for your house, but you can also use it for a few other things like investments or even education loans. Next is the special account, or SA. This one is your retirement booster. The money here is strictly for your retirement, so you can't use it for things like housing. Because it's for the long term, it earns a higher interest rate, which really helps to supercharge your retirement savings. And finally, there's your MediSave Account, or MA. This is your personal healthcare shield. The savings in this account are there to help you pay for medical bills and health insurance premiums for yourself and your immediate family. It's a real lifesaver when you need it. Okay, now for the really cool part. Your CPF money doesn't just sit there. It grows. And the interest is guaranteed by the government, so it's risk-free. Your ordinary account earns a guaranteed floor rate of 2.5% per year. That's way better than what most regular savings accounts offer. But here's where the magic really happens. Your special and MediSave accounts, the long-term ones, earn a guaranteed minimum of 4% per year. Now that difference might not sound like much, but over a 30 or 40-year career, the power of compound interest turns that extra percentage into a massive boost for your retirement fund. And there's more. The government also gives you an extra 1% interest on the first $60,000 of your combined CPF savings. It's a fantastic little bonus designed to help everyone, especially those just starting out, to build up their savings just that little bit faster. So, we've met our tools, the OA, SA, and MA. Now, let's get practical and see how you can actually use these tools to achieve some of the biggest goals in life. The big Singaporean dream, right? Buying your own place? Well, your ordinary account is the key. You let the savings build up, then you can use that money to cover the down payment for your flat. After that, you can use the money that flows into your OA every month to pay off your monthly housing loan. This means many people can service their entire home loan without ever touching their take-home cash salary. So if you're ever chatting with your friends and someone asks, "Can you CPF for that BTO down payment or not?" The answer is a huge, definite yes. Can one la? That's literally what the system was built for. At the same time, your MediSave account is acting as your healthcare safety net, and it covers a lot. We're talking hospital stays, surgery, paying for essential insurance plans like MediShield Life, and even things like vaccinations and health screenings. It really gives you peace of mind. So, housing is covered, healthcare is sorted, but let's talk about the final boss, retirement. This is the original core purpose of CPF, making sure you have money to live on when you're no longer working. Here's a quick roadmap of what to expect. At age 55, a new account is created for you, the Retirement Account, or RA. Money from your SA and OA is moved here to form your retirement pot. Then, from age 65 onwards, you can start getting monthly payouts from this account. And hey, if you don't need the money right away, you can choose to delay your payouts up to age 70 and you'll get a higher monthly amount later. Okay, so how much money are we talking about? It depends on which retirement sum you manage to save up to. This table shows the targets for 2026. If you hit the full retirement sum, you can look forward to about $1,780 a month, every single month, for the rest of your life. And if you manage to save even more and hit the enhanced sum, you're looking at over $3,400 a month. That's a steady paycheck in retirement. And how does this work? It's all thanks to a national plan called CPF Life. It's essentially an insurance plan that turns your retirement savings into a monthly income that you can't outlive. And that's the key. It pays out for as long as you live, so you'll always have some money coming in, no matter how long and happy your retirement is. All right, we've gone through a lot, from contributions in accounts to buying a house and planning for retirement. So let's just zoom out and put it all together. Why should you care about your CPF? At the end of the day, your CPF is your all-in-one toolkit for life in Singapore. It's the tool that helps you get a roof over your head, it's the safety net that catches you when you have medical bills, and it's the plan that ensures you'll have a steady income to enjoy your golden years. So, that line item on your payslip, it's not just a deduction. It's you investing in your future self with every paycheck. It's your personal financial toolkit built to help you succeed in Singapore. The only question now is, what are you ready to build with it?